world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here.
Hello and welcome to Rebank. I'm your host, Will Beeson. Today we're joined by Dan Hegarty, founder and CEO of Habito. Habito is a digital mortgage platform helping homebuyers make sense of the more than 10,000 mortgage offers available in the UK. Habito is backed by some of the biggest names in venture capital, including Mosaic, Ribbit, and Atomico. As always, connect with us on Twitter, Facebook, LinkedIn, or on our website at bankingthefuture.com. If you enjoyed today's episode, please subscribe on iTunes or your podcast platform of choice and leave us a review. Thank you very much for joining us today. Please welcome Dan Hegarty. Dan, welcome to Rebank.
Thank you for having me.
You are the founder and CEO of Habito, a digital mortgage platform.
That's right.
How do you describe Habito in, a few sentences when people ask you about it?
So effectively what we've built is a place where UK consumers can search all of the mortgages in the market, receive free mortgage advice 24/7, and apply online for the mortgage that's right for them.
Mm-hmm. Excellent. Easy.
That's it.
And that is a pain point that probably won't be unknown to many listening. I mean, interestingly, having recently kind of gone through that process
with Habito.
Through the should we buy a property or shouldn't we?
Okay.
How do we make that decision? What information do we need? And this is coming from someone who considers himself to be financially literate, and it still probably took me the better part of 2 months to figure out, basically should we or shouldn't we? In the end, we opted not to, but it did, meant conversations with mortgage brokers, conversations with banks. It was not a straightforward process, and the information was not easy to piece together. So presumably the mortgage piece, i.e., holding someone's hand through the process, is a fundamentally important one. Probably there's a bit of even upstream work as well in terms of getting people comfortable with the home buying decision and how they think about not only property as an investment, but also as a home.
Yeah, I think that's all absolutely correct. I guess so. Maybe a useful kind of encapsulation of some of that was my own experience, which kind of led to the genesis of Habito, which was about 3 years ago. I bought my first house, and again, very similar to you, I kind of conceived of myself as pretty financially literate, and I'd been in fintech for a while. But obviously, if you're not buying homes, you're not really thinking about mortgages. Like, why would you? So I went through one of the free brokers that I found on the internet, a kind of manual call center based operation, and had this just bizarre experience. And bizarre on two fronts. One, practically bizarre, because what actually happened was they missubmitted my application to the bank, and they put me, my wife on the application, which was rejected after 10 days on the grounds of bigamy or polygamy or whatever else. They then, realizing I got a little emotional at that point.
So you only have one
I only have one wife for the moment. I'm working on it. But then, so the broker, realizing his error, then removed me from the form and just submitted my wife and my wife. And actually, now having filled in some of these forms myself, now I can see how it could have happened. At the time, I was less tolerant about it. And then eventually, but this is 20 days now into in the middle of a chain, trying to convince sellers that we're creditworthy and we're going to be good buyers. So it was kind of, in retrospect, it was kind of funny, but at the time it was anything but. And what I recognised was, one, that there was some, the fundamental plumbing of the mortgage market, from a digital perspective, just didn't exist. But also that I was in this kind of state of very high anxiety and stress, with very low comprehension on what was probably the most important financial decision of my life. And I was completely disempowered, completely unsupported. And I guess that was what struck me fundamentally, even more than the kind of we could make this better with technology side of it, was that the kind of the entire process entirely ignores the consumer. like the product definitions, the jargon, the kind of the long-term implications when you're being asked to focus on short-term incentives. It just didn't make any sense for the customer.
Yeah. So to keep it serious for just another minute, the venerable news outlet, the BBC, in an article about you, described you as having muscled arms, which they attributed to your previous career as a musician.
Yeah.
That was it jumped off the page.
I felt very objectified by that. I was very,
as you should have.
I was outraged, absolutely outraged.
This is a publicly funded news outlet.
I know.
Unbelievable.
It's deeply inappropriate.
Unbelievable.
Not really accurate. If I'm being completely, this isn't modesty. I would put me in the middle on the arm size or musculature.
So you did spend a number of years, I guess, as a professional musician before getting into mortgages. So downgrade, it would seem, in terms of career move. Yeah, well, there you go. There's still time. But so I mean, how did that play out?
So actually, yeah, that's what happened. I started. I guess my first job was being a guitarist in a pretty terrible little punk band when I was about 14. That band got a record deal. And so obviously I jettisoned my education as quickly as I possibly could and went off on tour with this little band. That
when you were, what, 16?
16, wow. Yeah. So I had a little bit before that, but kind of went back and mostly failed the exams. So my grandparents didn't get sent to prison. But it was, and that kind of sent me off on a pretty rocky road of making some good music with some good bands, but mostly pretty terrible music as a session player, just so I could kind of pay my rent and continue to live and make terrible music in my spare time. And that kind of led me over to Los Angeles, where I was based for some of the early part of my 20s. And I kind of, after about 10 years of pretty solidly, sitting in rehearsal rooms with lots of dudes, sitting on buses with lots of dudes, and mostly playing music that I wasn't terribly excited about. I turned up back in London, kind of missing my friends and kind of hoping to stay back for the summer, and thought maybe it was time to try something else. And I had a friend who was an opera singer, and who I'd met through music, but who was also, it turned out, not that I really understood, but was an M&A lawyer, and had was doing a lot of kind of early stage VC stuff in London. And I asked her if perhaps she would be able to find me a job, somebody without any qualifications or education. And she had just she'd in fact just done this Series A for the guys.
She said, of course, the tech industry.
This is perfect for you, you're going to fit right in. And so she'd just done the early stage funding for Wonga. And so it was like, oh, you should meet this guy, like he might have something for you. We met, and I kind of, my plan was to stay for a couple of months and probably get back on the road. And I was drawn into this incredible universe of just massive credit geekery and data and product design, and was kind of tremendously excited about it. And it turned out that I was a massive geek, and I'd been on exactly the wrong path for quite a long time.
So that's interesting. So through the Wonga experience, presumably Wonga plus what you're now doing at Habito, and where I understand your interests lie around kind of financial wellness, financial education, you've probably seen both sides of financial literacy, or indeed, people who maybe aren't in particularly good places when it comes. So I suppose for context, maybe those who aren't UK based, aren't familiar with Wonga, it's a payday lender. Had all sorts of bad press over the years. I think they even kind of wrote off some debts at one point because they had basically loaned money to people who had no chance of paying it back. So as a result, it must have been a formative experience, both on the kind of tech entrepreneur side and also on the financial literacy, financial well-being side.
Yeah, absolutely. So Wonga was, like an education on many levels, some positive, some negative. I think on the positive side, like Wonga, kicked off in 2007, was certainly, I think the first fintech in Europe, really, of any note, and certainly the first place that kind of really brought kind of consumer finance to the internet and was able to offer like real-time loans and do real-time underwriting. So I think on that front, like I learned an extraordinary amount about user experience and technology and credit risk and analytics and everything else. I think on the other side, what was troubling to me is, and I don't think this is specific to Wonga or payday lending for that matter. I think it covers overdrafts, credit cards, unsecured lending in general. When you are a money lender of any form, like, you are ultimately set in opposition to your customer. Like, you can talk about customer centricity and service, but ultimately, like, you make more money when they make less money. So I came out of Wonga just very, very keen not to be in that position again. Like, I wanted to be aligned and have aligned incentives with the customer. So you could, because there's a real implication to culture when you're living in a place where your incentives are not aligned. So that was really why, when I was kind of looking around for a different broken thing to fix, and mortgage kind of fell into my lap in a kind of a literal sense. The kind of brokerage side and the aggregation and intermediation part of that product was very attractive to me.
So, I guess on that note, you mentioned right before we started recording that you had maybe spent part of the morning today at a some sort of government event around financial literacy, right? Mm-hmm. Can you talk at all about that?
Absolutely. So, of all kind of, financial services pretty full of jargon generally, but mortgage is extraordinary, from SVRs to ERCs to LTV to 2-year fixed rates. It's a universe of jargon and misinformation. And we've been doing quite a lot of kind of quantitative research on the implications of that and what that does for and to consumers. And what we found, so we recently did a piece of work with the University of Manchester that showed that 55% of UK mortgage holders are overpaying on their mortgage and could be saving if they switched. But not by trivial amounts. So they're overpaying on average. I think the saving was £294 per month.
Per person,
on average, which is an enormous number. And we're all talking about switching our energy or optimizing our forex or whatever. But actually, these numbers completely pale into.
In percentage terms, it's got to be I don't know, 20-30% of the average mortgage payment.
Yeah, I think it is. It's pretty much that, and it's. I think if you sum it all up, it's about £15 billion worth of interest being overpaid every year for no good reason. Other than, natural. So there are some subsegments of that are kind of stuck in that position because they've got a mortgage from 10 years ago, which has got a rate that they can't switch off of or whatever. But in general, what we see is there is massive inertia driven by a pretty horrible experience last time around. And bear in mind that, the house is highly emotive, right? The home is highly emotive. And, moving from that state of being, a kind of aspirational homeowner, to being an actual homeowner, and nobody really wants to go back in time and re-experience being on the other side, which I think puts people off. But also, customers don't really understand what they're signing up to. They don't necessarily understand what, a standard variable rate is. And the fact that, 25 months from the day they sign the contract, their monthly payment could double, and does in many cases double. So I think what we've been talking to government and talking more generally about is kind of trying to introduce a notion of free from, free from, I guess we borrowed from the food industry, but free from that jargon, free from acronyms, free from abbreviations that make no sense. Because when we looked at that research, we saw a pretty tight correlation between education level and the level of overpayment. So I think it was when we went through the contracts, the reading age required to understand a mortgage contract is at least undergraduate ready. So let's say A-levels or undergrad. That 50% of the population does not have that. And it turns out that it's that 50% of the population who are most probable to be overpaying. So I think something has to be done about that.
And interestingly, I guess, setting that almost to one side and then thinking about kind of the other end of the spectrum, I think you also have some strong views around the use of artificial intelligence around decision making and kind of automating a lot of what is now manual cognition by financial services consumers, and the way that might be automated in the future.
Yeah, I think for me it's one of the most interesting conversations to be had at the moment, because take mortgages for example. Mortgages are really only differentiated on price and eligibility. So there's no better or worse mortgage. There's just the cheapest one you can afford in real terms. So, we are, if the quantity and volume of marketing that is directed at you with pictures of happy family lives and lives well lived and horses running along beaches, whatever it might be to convince you that this Halifax is more appropriate than Santander, that is all nonsensical. And I think as we move more into a kind of not to use jargon, but a kind of product selection paradigm that is automated when you're letting, for example, in our case as a mortgage broker, we use an algorithm to determine which mortgage is appropriate for you, not because it's a hugely complex problem. In fact, it's really just some complex arithmetic to figure that out. But it's much better done by a machine. I don't think there's any doubt about that. Humans are not great at arithmetic. They're not great at filling in forms. So what happens so the machine can't be marketed to. The machine really only understands the rate and whether you can get it. So then what becomes the future of these financial services brands when they haven't, spending £1 billion on marketing isn't going to make the difference? And what becomes the new battleground? And I think there's a few different potential avenues there. I think, does it become a race at the bottom on price? Well, I think that's good for consumers. Does it become an issue of who can most aggressively reduce their operational expenses? They can pass that directly on to consumers, maybe. Do we get into a much more fine and granular kind of universe of understanding eligibility? So, can we look at people who have been, 7 months self-employed versus 13 months, and that's the way you put yourself above the other lender on the table? So I don't know. I think those answers, I think if the answer turns out the machines are better for all of that, then who becomes the fundamental brand that we learn to trust? It's not Halifax anymore. Maybe it's Monzo. Maybe it's Revolut. Maybe it's Habito. And I think those questions remain unanswered.
Looping back to your, I don't want to say founding story, but what you guys have built and how you've done it. It sounds like you've raised capital from some of the biggest names out there. So there are obviously VCs, institutions who are aligned with your vision of the future, and I think some interesting seed investors too. You want to run through some of those backers early on?
Sure. So on the institutional side, we did a early stage with Mosaic, followed on with Ribbit, who are a West Coast fintech specialist firm who are very, very good. And then our Series B was led by Atomico. So, look, a really brilliant bunch, actually. And I probably won't go on record saying terrible things about them, but they actually are a pretty good bunch of dudes who I think fundamentally believe that, something transformational is going to occur in mortgage. And in some ways, it feels like the last kind of undiscovered country of fintech, like everything else has been touched. But mortgage is such a thorny and complex, and both from a regulatory and a kind of consumer emotive standpoint, challenging product to solve. You can see why it's been done last. So I guess they buy into the fact that we've got a shot at being that transformational business. On the seed side, so we had Tarvit from the CEO of TransferWise invest very early. We had Samir from Funding Circle invest. And I've got a real bias, rightly or wrongly, towards having kind of operational or recently operational investors on board, just because there's so much just practical stuff involved in building these businesses, from figuring out, who to hire in what order and what which communication strategy to follow. And actually those guys have been invaluable, really, really value additive at every stage.
So is your vision, and I suppose by extension the vision that those guys bought into, is it every mortgage written is going to be written through Habito in 10 years, or is it digitizing the mortgage process is kind of the first step in a much larger, much broader automation around a meaningful chunk in people's financial lives?
So that's a great question. So we think primarily about, I guess everybody says this, but we look through the lens of the consumer beyond anything else. And right now, there are certain components of the mortgage journey, like discovering which product and making the application, that we can help with. But in many ways, we're still, at the end of the day, if you're still ending up with one of the big retail banks, you've probably got 30 or 40 days until you're going to complete on that mortgage. So our primary focus is kind of that deep vertical integration, so getting beyond just advice and application and seeing how we can work with lenders or other institutional providers of capital to get towards real-time underwriting, towards real-time completion. Certainly on remortgages, absolutely no reason they couldn't be completed in real time. So that's a lot of where our efforts and I guess our R&D is focused.
You mentioned the likes of the Monzos and Revoluts of the world. Is part of your, I was going to say future vision of Habito, but maybe it's something you're already working on, is kind of plugging into marketplaces and allowing interconnection between current accounts and something like Habito part of the plan?
Absolutely. So we already partner with Starling in their marketplace and are rolling out with a number of other partners. Maybe some of those that we've mentioned over the kind of the next couple of quarters. I think that makes a very natural sense. I also think when you conceive of whether it's a Starling or a Revolut or a Monzo, these guys are very much in the kind of the everyday financial services. How much did you spend on coffee today? Like, what are you doing about your holiday spend? So I think we occupy a very different space. We're a much more low frequency product and a much kind of more complex and kind of more heavily advised product. So I think there's a kind of natural separation between where our expertise works best, and so it makes a bunch of sense that we would work together to acquire and share customers.
Mm-hmm. So what does that flow look like? It sounds like you're already live in the Starling marketplace. So if a Starling customer wants to interact with Habito, how does that work?
Yeah, it's actually we did a pretty good integration actually. Often these kind of first runs at these things can be a bit clumsy, but actually they've been a very good partner. So so you would enter into the Starling marketplace component of their app. We're there along with energy suppliers and whoever else. And actually we've both got an OAuth connection, so you can come through using your Starling login details, have an account created automatically. You wouldn't have to re-input data that you've already re-inputted on the Starling side, and then you'd be handed off into our kind of automated advice journey, product selection process, and eventually off to full application.
And so it's still through a Starling interface. You're kind of passed to the Habito app or website.
You're passed off to us at the point of login, effectively.
Gotcha. Excellent. Cool. Well, where can people find out more about Habito and connect with you guys?
Head over to habito.com, habito.com. If you need some free 24/7 mortgage advice, we're always there for you. And I guess we're on a pretty decent road at the moment in terms of growth. So we're very happy to help whoever needs help.
Excellent. Dan Hegarty, thank you very much for joining us today.
Pleasure. Thank you for having me.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.